Welcome to another video of financial indicators by Fahad M. Gohar. Today we'll be addressing a subject that's really very important. This subject name is the Volatility Index, or the other name it's called the Fear Index. What it is actually, it's a measure of the market expectation of volatility over coming 30 days. Remember that, 30 days. Usually investors use the VIX to make decisions about hedging, market timing, or plan for volatility based strategy of trading. So it's very important subject to address and to understand. You have to remember, if the VIX is high, the market might see larger than normal swing. You see, swing in what? On the price. It could go up, it could go down. Some investors might see this as an opportunity to make profit through short-term trades, of course. Short-term, and there is a long-term. While others might become more risk averse, reducing their position, of course, to avoid when the market goes down. When the VIX is high, as I said, investors expect more significant price swing up or down during, of course, a major could be geopolitical events or financial crisis. And when it's low, investors expect what? A calmer, more stable market. Now, the VIX has an effect on the 500 S&P. Okay, the VIX, of course, is calculated what? We are using the price of options on the S&P index, in the next 30 days. Of course, options are, as we know, they are financial instruments that give investor the right, but not the obligation to buy or sell index at specific price before specific days. Of course, as I explained, the performance of the VIX is inversely related to the S&P 500. When the price of the VIX goes up, what's going to happen to the S&P? It will go down. When the price of the SP usually goes down, then when the price of the VIX goes, when the VIX goes down, the price of the S&P will go down. Okay, so you can see the relationship, it's an inverse. Now let's find out how we calculate, that VIX. To calculate it, there's three methods, okay? The first method we're gonna use here, we call it the selection, of options. That's the first method. The VIX, of course, is calculated here by using the price of a wide range of S&P 500 options that are set to expire within the next 2 months. It includes both calls and put options that are close to the current level of S&P index. Of course, everybody knows what's S&P index, I hope. What it is actually is a tracker of the biggest 500 companies, within the stock market. And of course, you cannot trade the index, but you can trade the S&P 500 index fund. Now, the second method of calculating the VIX will be called the implied volatility calculation. VIX is based, of course, here on the concept of implied volatility, which is the market forecast of a likely movement in the underlying asset price. Implied, of course, volatility is calculated using mathematical models. Often, the one that everybody uses is the Black-Scholes model. And the third method of calculation is aggregation. The implied volatility from different strike price, of course, of the option and expiration are then combined to produce a single figure that represent the VIX. So now let's see how that VIX, it's put together. VIX has levels, several levels, one level 2 level, 3 level, 4 level. Okay, so now we're gonna go ahead and study those levels. Okay, the first level here will be when it is 15. You know, that's what we call it low VIX, which is below 15. Here the market participant expects stable low volatility condition. Of course, it corresponds with a steady rising market. Okay, now it consider, of course, low risk here. However, it can also indicate complacency in the market, which sometimes precede market correction. Now the second level, it's when it is 20. What we call it here, it's the moderate VIX, between 15 and 20. Of course, this range here, you know, is often seen during normal market condition, where, you know, there are some expected movement, but nothing is extreme. It's considered regular. It's neither a signal of high fear nor extreme complacency. The third level is when it is 30, you know, what we call it here elevated VIX, between 20 and 30. It signal what? It signal market participants expect increased volatility. Could be due to, of course, to uncertainty. Maybe there are political or geopolitical issues, as upcoming economic data release, you know, or geopolitical event. Consider, of course, somewhat risky. The market may experience sharp swing here in either direction, going up or going down. Now the other level here, what we call it, you know, below the 40, you know, but above the 30, we call it high VIX. As long as it's above 30, consider high VIX, but it's below 40 still. It indicates significant fear, you know, and uncertainty in the market. It happens usually during major economic downturn and financial crisis or other significant, you know, global events, maybe war. High, it's considered, this is a signal that the market could see significant volatility and large price swing here going on. Often, of course, in a downward direction. Anything above 40 is considered extreme. You know, of course, an extreme high level above 40 signals panic and extreme fear in the market. This is usually seen during financial crisis or other catastrophic event. Very high. Such levels suggest extreme market condition where price could be very unpredictable. So now you can see those levels, and we, you know, explain them. So it's very easy now to spot the volatility in your market and how, you know, it's measured and how it reflects what the investor are, you know, feeling. Now let's see, when the VIX goes up, effect, or when the VIX goes down, what it will affect, what other sectors, you know, what other indications, what other, you know, element will affect. Of course, the S&P index first. You know, the S&P index, what's gonna happen to it when the VIX is up? You know, of course, it's gonna go down, because remember, VIX goes up, participant, which is investors, are worried, you know, and scared. They're not gonna invest on those companies, and those companies are part of that S&P 500 index, so their prices will go down and S&P will go down with it, you know. Second, let's see what's the effects going to be on the bond. You know, what's going to happen to those bond now. And as you can see, you know, what's going to happen when the fear, you know, saturate within the investors. What's going to happen? The investors will rush and try to protect their investment. What's the safest way? Buying bonds, you know, because bonds are more safer. So the bond will go up. because the bond considered safe here, because the bond is guaranteed by governmental entity usually. And what about the stock market? Of course, the stock market, we know companies will be affected, stock market will go, usually down. Now, how about the gold prices? Right away you can understand. When the VIX goes up, people want safer, investment. What's gonna be here? We said is the bond and also the gold will be a safer. So the gold prices will go up. What about then the crypto? Remember crypto, Bitcoins and all that stuff. Here, because the crypto is not based on an actual monetary value, it's all digital. So therefore there will be a swing between either going up, or either going down. Depends on the feeling of the investors. But when the VIX goes down, what's gonna happen to the bond? Of course, people will lose interest in the bond because now the market is great. They want to invest on companies. So the bond, prices will go down. What about S&P index 500? Of course, now the VIX is down. Companies are making great investment and great profit and great revenue. So their S&P will go up. Okay. What about the gold prices? As we said earlier here, here because the investors went to invest in the gold in order to protect ourselves because it's safer. Now, the gold prices, it's no longer, it's a safer still, but it's not that attractive as the S&P 500, So what's going to happen to it? The gold prices will go down. So I hope this really was a great, introduction for you about the volatility index. I'll see you in the next video. Goodbye.